Inflation.
Rapid inflation.
High inflation.
Can you remember how much a Big Mac cost 10 years ago? According to the Big Mac Index by The Economist, the price of a Big Mac in 2022 has increased by a staggering 40% compared to 2012. As of May 2020, inflation is at a 40-year high, increasing 8.6% over the last year. President Biden alluded inflation to the Russian-Ukraine conflict, but is that the case? In 2020, the COVID-19 pandemic struck the world, causing immense uncertainty and fear, leading to a sell-off in markets worldwide into a bear market. To contain the economic fallout, the United States Federal Reserve responded quickly by cutting interest rates to zero and launched an unlimited quantitative easing program, a vital policy used during the Great Recession. Due to these measures, the U.S. stock market experienced the shortest bear market in history at only 33 days. Despite the stock market's rapid recovery, there are severe consequences to the Fed's easy money policies. Reducing interest rates incentivizes borrowing for businesses and consumers for spending and capital investment. When a bank loans money, new money is created and injected into the economy. Along with quantitative easing, where the central bank purchases assets from the open market to increase the money supply, thereby stimulating spending and investment. As a result, the M2 money supply has increased from $15.4 trillion to $21.8 trillion since the start of the pandemic, a 40% increase in merely 2 years. For comparison, the M2 money supply took 8 years to increase by 40% before 2020. The sudden significant increase in money supply is beneficial short-term to stimulate spending and prop up the economy, but history warns of the danger of currency devaluation, hyperinflation, and eventual total economic collapse of empires. Charlie Munger, Warren Buffett's right-hand man and vice chairman of Berkshire Hathaway, claims that inflation is a very serious subject. You could argue it is the way democracies die. Munger used the Weimar Republic as an example of the severity of inflation. Drowning in massive war debt and severe concession of land after the peace treaty of Versailles, Germany, under the newly formed Weimar Republic, was forced to pay reparations to the Allied powers. The mark, Germany's currency, was not backed by any economic assets like gold at that time. To meet their debt obligations, Germany printed money out of thin air, drastically increasing the money supply, which made the currency worthless. Hyperinflation followed, and the cost of living index increased from 41 to 685 within 6 months, a nearly 17-fold increase. As its currency devalued into worthlessness, Germany defaulted on its debt obligations, and the Ruhr Valley, Germany's industrial region, was occupied by France and Belgium, forcing repayment to be paid in coal. By late 1923, $1 US was worth 4.2 trillion marks, and a loaf of bread in Berlin that cost roughly 160 marks in 1922 had risen to 200 billion marks. A century after the collapse of the mark, the USA sits in a precarious position. In October 2021, Treasury Secretary Janet Yellen emphasized the urgency of lifting or suspending the debt ceiling to avoid default, resulting in the debt ceiling raising by $2.5 trillion to $31.4 trillion. The U.S. national debt currently stands at an unprecedented high of $30.5 trillion as of June 2022. The GDP to debt ratio is at 129% compared to 57.64% in 2000. This means that if the USA were to repay its debt fully, it would take 1.3 years, using its GDP solely for debt repayment. The risk of default increases significantly as the GDP to debt ratio increases. However, modern economists seem to think default is unlikely. According to the modern monetary theory, the government can print as much money as they need due to the inability to go default barring political reasons. This quote from the book Dying of Money, Lesson of the Great German and American Inflations aptly sums up the fall of the Weimar Republic. It goes, "The life of the inflation in its ripening stage was a paradox which had its own unmistakable characteristics. One was the great wealth, at least of those favored by the boom. Many great fortunes sprang up overnight. The fever to join in turning a quick mark infected nearly all classes, and the effort expended in simply buying and selling the paper tiles to wealth was enormous. Everyone from the elevator operator up was playing the market." Sounds familiar? The author then continues, "Side by side with wealth were the pockets of poverty. greater numbers of people remained on the outside of the easy money, looking in but not able to enter. The crime rate soared. Other workers fell behind the rising cost of living into real poverty. Salaried and white-collar workers lost ground in the same way. Even while total production rose, each individual's own efforts faltered and showed a measurable decline, and the quality of production deteriorated. Accounts of the time tell of a progressive demoralization which crept over the common people, compounded of their weariness with the breakneck pace to no visible purpose, and their fears from watching their own precarious positions slip while others grew so conspicuously rich. This account of the Weimar Republic sounds eerily familiar, describing a bull market not unlike the 2020-2021 bull market and a rapidly increasing gap between rich and poor. The public is waking up to the realities of unconstrained money printing as they feel the effects of inflation rob them. Ron Paul, author of End the Feds, said, "The most sinister of all taxes is the inflation tax, and it is the most regressive. It hits the poor and the middle class. When you destroy a currency by creating money out of thin air to pay the bills, the value of the dollar goes down and people get hit with a higher cost of living. It's the middle class that's being wiped out. It is the most evil of all taxes." The Weimar Republic's monetary system eventually collapsed. Due to the modern monetary theory and the US dollar being the world's reserve currency, the downfall might not be as violent and rapid as the Weimar Republic. However, as the dollar continues its downward spiral with rampant printing, rising inflation, and labor shortage, will consumers eventually be unable to afford daily necessities? Undoubtedly, the economy is dancing on a knife's edge. Are we at the precipice of a collapse like the Weimar Republic? Share your thoughts in the comments section. Thank you for watching.